This is no longer just a North American dispute, it's a shockwave shaking the global economy. Canada has just proposed a 100% tariff on Tesla, an unmistakable symbol of America's electric vehicle dominance. While this might seem like a tit-for-tat retaliation against Trump's escalating trade policies, experts warn it could radically upend the North American auto ecosystem and beyond. Canada and the U.S. have maintained one of the most intertwined automotive and metals trade relationships in the world, exchanging over $50 billion in cars, aluminum, and steel annually. But under Washington's latest protectionist pivot, that balance is now under siege. According to Reuters, Trump's revived tariffs on Canadian imports have been framed as efforts to protect U.S. industry, yet they risk backfiring spectacularly. "You don't slap your closest trading partner without expecting a strategic counter," said Christopher Sands, director at the Wilson Center's Canada Institute. With this tariff bombshell, Canada isn't just sending a message, it's rewriting the rules of engagement in the EV economy. And the world is watching. Why Tesla? Why now? The answer lies in symbolism and dominance. Tesla isn't just a car company, it's the face of America's clean tech ambition. In the U.S., it commands a staggering 70% share of the electric vehicle market. By targeting Tesla with a 100% import tariff, Canada isn't merely retaliating, it's striking at the crown jewel of the American green industrial strategy, and the economic shock could be severe. A report from Bloomberg projects that a 100% tariff would effectively double the price of a standard Tesla in Canada, from $40,000 to as high as $80,000. That kind of hike could decimate demand overnight. As Dan Ives, senior equity analyst at Wedbush Securities, notes, Tesla's pricing power is already stretched. Slapping a 100% tariff in one of its key foreign markets could be a nightmare scenario for shareholders. This isn't just about trade anymore, it's about leverage, and Tesla has become collateral in a broader geopolitical chess match. The consequences of Canada's proposed tariff go far beyond sticker shock. Tesla's market presence in Canada is more than symbolic. It represents over 50,000 units sold annually. That's not just business, it's strategic territory. If the tariff is implemented, Tesla's sales could plunge. Investors wouldn't just face a temporary dip, they'd face a confidence crisis. Revenue, margins, and future expansion plans would all be in jeopardy. According to Reuters, the mere announcement of tariff threats has triggered concern among institutional investors. Morgan Stanley analyst Adam Jonas warned in a recent note, a prolonged tariff regime in Canada could complicate Tesla's North American roadmap and call into question the scalability of its international EV strategy. Tesla's investor community is already sensitive to geopolitical risks. This new front in the trade war could cause not only volatility in share price, but also hesitation in capital investment across the entire EV sector. And here's where the shockwaves start to spread. If Tesla, the most dominant EV brand, takes a hit, the message to the entire global industry is clear. Political risk is back, and it's targeting green tech. The disruption won't stop in showrooms. It will ripple through supply chains, slow down innovation, and potentially stall the very transition the world is betting on to fight climate change. You might think this is just about Tesla, but make no mistake, this is a systemic threat. If Canada follows through with the 100% tariff, it won't just squeeze one company, it will rupture an entire supply chain. A Tesla Model 3 priced at $40,000 could instantly spike to over $80,000 in Canada, an impossible leap for most consumers. Demand would collapse, but the ripple effect won't stop at Tesla. According to Bloomberg, Canada imports over 50,000 Teslas annually, but the real danger is what happens next: retaliatory disruption. If this escalates, you could see a domino effect across Ford, GM, and Stellantis, warns Harvard economist Jason Furman. We're looking at potential shutdowns of joint facilities, layoffs, and multi-billion-dollar production losses. Over 2 million cars are assembled in Canada every year, many for export to the U.S. If a full-blown tariff war ignites, assembly lines could go dark, throwing hundreds of thousands out of work in both nations. This isn't just about trade. This is about how fast a political decision can trigger economic chaos across two tightly interwoven economies. Washington didn't see it coming. Canada wasn't supposed to fight back, but now it's rewriting the rules of the game. In a stunning pivot, Ottawa hit back with tariffs, new trade alliances, and a message, "We won't be bullied." The U.S. and Canada trade over $800 billion annually. But when Trump doubled down on protectionism, he opened a wound in North America's economic heart. As reported by the Wall Street Journal, Canada's retaliation was swift and calculated. Trudeau's administration matched U.S. tariffs dollar for dollar, targeting American steel, aluminum, and key agricultural exports. The result? A double-edged shockwave. This is not a trade spat. This is a geopolitical counteroffensive, says Heather Schofield, senior economist at the Business Council of Canada. And Canada wasn't acting alone. Within weeks, it inked new trade deals with Indonesia, Ecuador, and most critically, strengthened ties with the European Union. The message was loud and clear. Canada's future won't be dictated from Washington. This isn't just a reaction. It's a reorientation of Canada's global trade posture. The U.S. isn't just losing a partner, it's losing leverage. When Donald Trump slapped tariffs on Canada, he expected silence. Instead, he ignited a chain reaction that could rewrite North America's trade order. Prime Minister Justin Trudeau called the tariffs completely unjustified, and then unleashed a full-scale economic counterstrike. Canada immediately imposed retaliatory tariffs on American goods of equal value, not symbolic ones, but precisely targeted strikes: U.S. steel, aluminum, beef, dairy, and fresh produce. These weren't just economic sectors, they were political battlegrounds in swing states. According to Reuters, Canada's retaliation was crafted with surgical precision, aiming to inflict maximum economic and political discomfort in key U.S. constituencies. This wasn't retaliation for the sake of it, it was deterrence in action. But Canada's strategy went even further. Ottawa accelerated trade diversification, signing deals with Indonesia and Ecuador, while fast-tracking existing frameworks with the EU. This shift wasn't about short-term relief. It was a strategic repositioning for long-term independence from U.S. volatility. By reducing dependence on Washington, Canada turned a crisis into a catalyst, and in doing so, it forced America to confront an uncomfortable truth. Economic dominance isn't a given. It's a privilege that can be lost. But Canada's next move wasn't just bold, it was strategic, global, and dangerously effective. In a quiet yet seismic shift, Canada joined forces with the European Union to form a strategic minerals alliance. This alliance targets the lifeblood of tomorrow's economy, critical minerals like lithium, cobalt, and nickel. These aren't just resources, they're the foundation of electric vehicles, clean energy, and advanced tech. And until now, China controlled over 90% of this global supply. As the Wall Street Journal reported, Western nations are scrambling to secure access to critical minerals amid rising geopolitical tensions. Canada, already rich in reserves, saw its moment. With EU capital and political backing, it's now laying the groundwork for a new China-free supply chain. For Washington, this alliance is more than inconvenient. It's a wake-up call. While Trump waged tariff wars at the border, Canada quietly built the future behind his back. And the warning is clear. Without a modern, stable trade strategy, the United States may find itself not just isolated, but irrelevant in the next-generation energy race. The trade standoff between the U.S. and Canada has now burst beyond auto tariffs and electric vehicles. It's reaching straight into the global food supply. When the U.S. imposed a 25% tariff on Canadian agricultural goods, including grains, meat, and dairy, Canada didn't blink. It retaliated immediately with matching tariffs on key American exports, corn, soybeans, and beef. According to Reuters, Canadian officials aimed for precision. Retaliatory tariffs were designed to maximize political pressure while protecting domestic stability. By targeting the U.S. heartland, Canada wasn't just hitting the economy, it was aiming straight at American farmers' political influence. And the impact is already visible. U.S. farmers are drowning in surplus, prices have plummeted, warehouses are full. and markets once dominated by American exporters are now wide open to competitors from Brazil, the EU, and even China. What began as a battle over cars is now becoming a crisis in agriculture, and this is just the first tremor. The aftershocks, economic and political, could shake rural America all the way to the 2026 midterms. America's dairy and livestock industries are now bracing for impact. For decades, Canada has been a critical buyer of U.S. milk, cheese, beef, and pork. But retaliatory tariffs have flipped the tables. Exporting has turned into a losing game. U.S. dairy farmers are watching their margins collapse. Shipments that once crossed the border without friction are now blocked or heavily taxed, making American dairy uncompetitive. As reported by the Wall Street Journal, the National Milk Producers Federation warned that current price conditions are unsustainable, with many small farms already announcing closures. It's not just dairy. Corn and soybean growers, long reliant on Canadian buyers, are now stuck with unsold crops, pushing prices further into a downward spiral. The livestock sector is facing a perfect storm: high feed costs, rising export barriers, and collapsing foreign demand. One Iowa-based hog producer told Bloomberg, "We're getting crushed from both ends. Can't export, can't survive. If this keeps up, we're done." This isn't just a trade dispute anymore. It's an unfolding rural economic emergency, and the ripple effects could define the next political cycle in key swing states. What began as a tit-for-tat over car tariffs has now mutated into a full-scale agricultural reckoning. The fallout from the U.S.-Canada trade war is cracking the foundation of North America's farm economy, one sector at a time. In the U.S. Midwest, corn and soybean prices continue to nosedive. With nowhere to sell, farmers are forced to stockpile grain or dump it below cost. For livestock producers, skyrocketing feed prices and collapsing demand are squeezing already thin margins. According to Reuters, retaliatory tariffs have erased over $1.2 billion in U.S. agricultural export revenue within just 3 months, prompting renewed calls for federal aid. But this isn't just about lost profits. The emotional toll on farming communities is growing deeper. Farm bankruptcies are on the rise. Mental health hotlines in rural areas are reporting record activity. A report by CNN Business found that more than 60% of small family farms in the Great Plains are now considering selling to large agribusinesses. This isn't just a business decision. It's a generational collapse. At the national level, lawmakers are under pressure. Representatives from Iowa, Wisconsin, and Nebraska are calling on the White House to renegotiate terms before rural America reaches a breaking point. This isn't merely economic damage, it's political dynamite. With rural votes swinging key elections, the farm crisis is rapidly becoming the next front in America's internal reckoning over trade policy. But the economic firestorm doesn't stop at agriculture. It's heading straight into the heart of America's energy security. What if Canada, the largest supplier of U.S. oil and gas, simply turned off the tap? Canada currently provides nearly 60% of America's crude oil imports. According to the U.S. Energy Information Administration, over 4 million barrels of oil flow into American refineries from Canada every day. Canada isn't just a friendly supplier. It's a foundational pillar of U.S. energy stability, said Professor Jason Bordoff, founding director of the Center on Global Energy Policy at Columbia University, in a recent Bloomberg interview. Hydroelectric power from Quebec lights up states like Vermont and New York. In winter, Canadian natural gas keeps homes warm across the northern U.S. Without it, entire regions could plunge into blackouts and supply chaos. Uranium from Canada fuels America's nuclear plants, another critical piece of the puzzle. A disruption here wouldn't just raise prices, it could throw energy markets into total disarray. In an era of geopolitical uncertainty, relying on one nation for the majority of your energy imports is more than risky. It's a ticking economic time bomb. Now imagine this. What if Canada decided, overnight, to cut its energy exports to the United States? No more oil, no more natural gas, no more hydroelectric power. The consequences would be immediate and catastrophic. Without Canadian oil and gas, U.S. energy prices would soar. According to the American Petroleum Institute, a disruption in Canadian supply could push gasoline prices up by 20% within weeks. That's not just pain at the pump, it's an inflationary shockwave hitting every American household. And it wouldn't end there. Energy-intensive industries like steel, aluminum, and chemicals would be brought to their knees. Many factories simply wouldn't be able to operate profitably with soaring input costs. Winter would be even more brutal. Northeastern states, heavily dependent on Canadian natural gas for heating, would face shortages, blackouts, and sky-high utility bills. These aren't abstract risks. These are scenarios already modeled by the U.S. Department of Energy in recent contingency reports. This kind of energy disruption isn't just an economic issue, it's a national security crisis, warned Amy Myers-Jaffe, director of the Climate Policy Lab at Tufts University, in an interview with Reuters. The U.S. simply doesn't have the infrastructure to quickly replace what it gets from Canada. While some suggest Canada could reroute energy exports to Asia or Europe, energy experts caution that building the necessary infrastructure, pipelines, ports, and terminals would take years and billions in investment. The bottom line? If Canada shuts the valve, the United States won't just feel the heat. It could ignite a full-blown energy emergency across the continent. If Canada truly cuts off energy supplies to the U.S., the fallout would be relentless. Oil and gas prices would skyrocket. Production lines would grind to a halt. The cost of living would spiral out of control. Industries across America, especially steel and chemical manufacturing, would be crushed under soaring energy bills. According to a 2024 report by the American Chemistry Council, a 25% spike in energy prices could slash profit margins by more than half in less than 6 months. In winter, the Northeast could face rolling blackouts. Cities like Boston, Buffalo, and even New York rely heavily on Canadian hydro and gas to power homes and hospitals. That energy lifeline would vanish. The U.S. would be left scrambling to source fuel from distant allies like Qatar or Nigeria, options that are not only slower, but more expensive. And let's not forget the logistical nightmare of rerouting energy imports through already overstretched ports and terminals. Meanwhile, Canada has options. It could redirect oil and LNG to Asia and Europe, where demand is surging. According to Bloomberg, Canadian crude exports to China are already up 30% year over year, even before this crisis fully unfolds. If Washington thinks it can pressure Ottawa without consequences, it's a dangerous miscalculation, said Dr. Jason Bordoff, founding director of Columbia University's Center on Global Energy Policy, in a CNN Business panel. The energy interdependence between the two countries is real and deeply asymmetric. Bottom line, the U.S. energy security rests on a fragile alliance, and right now, that alliance is cracking under the weight of politics. While Washington escalates its tariff campaign, its closest allies are taking a quieter but far more strategic route, walking away. Canada is leading that retreat, actively dismantling its long-standing economic dependency on the U.S. Ottawa is no longer playing defense. It's launching a trade revolution. In a high-level diplomatic tour, Canada's Minister of Trade, Mary Ng, met with top EU officials to strengthen bilateral trade with Europe. This wasn't just a diplomatic gesture, it was a warning shot. Under the Comprehensive Economic and Trade Agreement, CETA, trade between Canada and the EU has already surged to a record $100 billion by 2021. Now, with U.S. relations deteriorating, that figure could climb even higher. Canada is also shifting its energy export strategy, long dominated by a 97% reliance on the U.S. Today, new long-term agreements with Japan and China are redrawing the map. According to Reuters, Canadian oil shipments to Asia are expected to grow 40% over the next 3 years. This isn't just economic diversification, it's a geopolitical pivot. Canada is preparing for a world where Washington is no longer its primary partner. America's protectionist stance is accelerating a global realignment, said Fiona Hill, former National Security Council advisor, in an interview with The Wall Street Journal. And Canada is showing how allies can adapt by building independent trade ecosystems. The message from Ottawa is crystal clear. If the U.S. wants to wall itself off with tariffs, Canada will simply build new doors. Canada's strategic pivot doesn't end with Europe. It's executing an even bolder play, redirecting its energy exports from the United States to Asia. For decades, nearly 97% of Canadian oil flowed south, but that era may be coming to an end. New energy deals with Japan and China are signaling a dramatic shift in Canada's long-term export strategy. According to Bloomberg Energy, these agreements could reroute up to 500,000 barrels per day to Asia within the next 5 years, reducing exposure to U.S. policy risks. This isn't just a diversification tactic, it's a high-stakes maneuver that enhances Canada's leverage on the global stage while diminishing America's energy security. At the heart of this transformation lies a crucial question: is the United States losing its grip on global trade leadership? As Canada secures new markets, America's protectionist policies are isolating it from the very alliances it once led. Tariffs, instead of strengthening domestic industries, are pushing allies into the arms of its rivals. The U.S. is no longer the gravitational center of global trade, noted Dr. Robert Scott from the Economic Policy Institute in a recent CNN Business interview. Its actions are forcing allied nations to rethink who they align with, and for how long. In a world of shifting allegiances, Canada's move is both defensive and visionary. The U.S. may be building walls, but Canada is building bridges. As allied nations pursue new trade routes, the United States finds itself at a crossroads. The very protectionist policies designed to safeguard American industries are, ironically, accelerating its decline in global influence. The ripple effect is already visible. Countries like Canada, the EU, Japan, and South Korea are weaving a new fabric of trade relationships, one where U.S. dominance is no longer a given. According to Reuters, American exports to key allies have declined by more than 12% in the last quarter alone, as partners shift sourcing strategies. And while America plays defense, Canada is advancing with a bold, forward-looking strategy centered on sustainability. Its mining sector is ramping up operations in critical materials, lithium, cobalt, and nickel, geared toward the green tech revolution. These projects are not only about resource extraction, they're about values. Canada is emphasizing ethical sourcing, indigenous consultation, and environmental protections, positioning itself as a responsible leader in the global energy transition. Canada's green industrial strategy is a game changer, said Dr. Emily Reichert, former CEO of Greentown Labs, in an interview with WSJ. It's not just about competing with China or the U.S., it's about defining a new standard for sustainable development. With bold energy reallocation, resilient partnerships, and ethical green tech investments, Canada isn't just reacting to U.S. tariffs. It's rewriting the rules of economic power in the 21st century. Canada is charging ahead, building not only trade resilience, but a blueprint for a post-American economic world. Its diversification strategy, once seen as a hedge, is now a full-scale pivot toward a more autonomous global footprint. Meanwhile, the United States faces a sobering dilemma: either evolve or risk isolation. As noted by Bloomberg Economics, continued reliance on tariff-centric diplomacy is undermining long-term trust among allies and creating self-inflicted vulnerabilities. Even U.S. companies are sounding the alarm. In a recent CNN business report, several CEOs voiced concern that America's shrinking trade footprint could lead to missed investment opportunities in clean tech, manufacturing, and digital infrastructure. Canada, in contrast, is actively shaping the industries of tomorrow. Through partnerships with Europe and Asia, it's securing supply chains, driving ESG investment, and positioning itself at the center of the green energy transformation. The question now isn't whether Canada can succeed without the U.S. The question is, can the U.S. afford to keep pushing its allies away? This isn't just about Canada and the United States, warned Professor Robert Deitz, former senior advisor at the Office of the Director of National Intelligence, in a Foreign Affairs column. This is about the unraveling of a global economic order that America spent 75 years building. In this new world, economic power will belong to the nations that adapt, partner, and lead on innovation, not those that retreat behind tariff walls. For the United States, the clock is ticking.